In this video, our last video of the semester, I'm going to discuss activity or efficiency ratios. Activity ratios are sort of a mix between profitability ratios and liquidity ratios. That's because they measure the ability of the company to sell its inventory, turn assets more broadly into sales, and collect its accounts receivable. Let's start by examining accounts receivable. Remember that accounts receivable are essentially interest-free loans to the customer. Companies are willing to provide these interest-free loans in order to boost sales. Not all customers are willing to wait until they have the cash to make a purchase, and companies exploit this fact by selling on credit. The first measure of accounts receivable is the accounts receivable turnover, which is technically net credit sales divided by average net receivables. So what do we mean when we say net? Net on the numerator, when we put it in front of sales, means after returns and allowances, discounts. And when we say average net receivables in the denominator, what we mean when we say net is net of the allowance for doubtful accounts. There's one problem here. If we are analysts from outside the company, if we're taking the investor's perspective or even a debt holder's perspective, we're using the financial statement information. We're not going to have this credit sales information. So this numerator works if we are within the company, and we have this internal data. Otherwise, what's going to happen is we are going to end up just simply using net sales because that's available on the income statement. And average net receivables, of course, will be reported on the balance sheet. Accounts receivable turnover measures the quality of accounts receivable. Lower quality receivables are less likely to be collected. A high accounts receivable turnover ratio can indicate one or more of a variety of factors. Ideally, it represents high-quality receivables. In other words, strong collections. Our customers that we sell to on credit have a strong ability to pay. If we're using net sales in the numerator, which as we're taking the perspective of an investor or creditor, someone outside of the company, we are using net sales in the numerator, well, it could mean that not many of the sales are on credit. And if the footnotes do not tell us anything about the credit sales, then it's likely that they will not. It's hard for us to determine whether a high accounts receivable turnover ratio is from this first factor or this second one. Related to both of these points, a high accounts receivable turnover could also signal that the company has a very conservative policy of granting credit. While a conservative credit policy is good because it limits bad debts expense, if the policy is too conservative, this could indicate that the company could be losing sales by not selling to customers with less than perfect credit, customers that might have the ability to pay. And of course, if this is what a high accounts receivable turnover ratio indicates, a low ratio can indicate low quality receivables, which may be due to difficulty with collections on behalf of the company, or a credit policy that is too liberal, meaning that too many customers are offered credit. A second measure of the quality of accounts receivable simply takes the accounts receivable turnover and divides it by 365, the number of days in the year. This is assuming that we are looking at our information, our ratio analysis on an annual basis. We call this the days in receivables. And it is simply 365 divided by our accounts receivable turnover. And again, all this does is change the answer from our accounts receivable turnover into a number that we can make a little bit more sense of. So it measures the average number of days it takes a company to collect a credit sale from the customer. A high days days in receivables, also known as days sales outstanding. These two terms mean the same thing. A high days sales outstanding shows that the company is selling its product to customers on credit and taking longer to collect that money from the customers. This could lead to cash flow problems because remember, this is an interest-free loan to those customers. A low days sales outstanding or days in receivables means it takes the company fewer days to collect its accounts receivable. Since accounts receivable, again, are interest-free loans, low values are considered better. So let's take a look at our companies that we've been analyzing, Gap, Urban Outfitters, and American Eagle. Now this is the same spreadsheet you've seen before, but I'm adding to it the activity ratios. Now first thing you'll notice for the accounts receivable turnover and days in receivables, these cannot be calculated. Because if we go to the balance sheet for Gap, we see not that they don't necessarily have any accounts receivable, but it's likely buried in this other current assets, which is very small. So one thing we do know is that they do not have much receivables. And because they don't report that information, we cannot calculate any measures, ratios on their accounts receivable. So let's go to Urban Outfitters. We have here the accounts receivable turnover, net credit sales. This is going to come from the income statement. Remember, we're not given credit sales, so we just simply use our net sales number. And then we're going to divide that by average accounts receivable. You can see here on this balance sheet that I added here in cell E5 a calculation of those average receivables to get accounts receivable turnover of 55.01. We can convert that into a number that makes a little bit more sense by taking 365, dividing it by the accounts receivable turnover in order to get the average number of days of sales that are sitting in accounts receivable, and we see that that's 6.64. You can access this spreadsheet in Blackboard and look at the formulas, and I suggest that you work through these calculations on your own just to get comfortable with them. So these numbers alone don't tell us a whole lot, but we can compare them over time or to competitors. Let's see how these numbers compare to those of American Eagle. Activity ratio we see for American Eagle 46.02, and days in receivable we see is higher for American Eagle than it is for Urban Outfitters. I've uploaded this information into this ratio analysis for all three companies. And what we're interested in is the accounts receivable turnover and days in receivables. And obviously here we can't look at anything related to Gap, but we see that Urban Outfitters is turning over its receivables or collecting its receivables faster and has takes fewer days to collect the accounts receivable. So we would say that Urban Outfitters is more efficient in its receivables collection. All right, the next thing we're going to do is analyze inventory. What is the company doing with inventory? Well, hopefully it is selling it, buying more inventory from its supplier, or making more goods from those raw materials, and then selling them as quickly as possible. The first measure we're going to look at of inventory efficiency is inventory turnover. And our numerator for inventory turnover is cost of goods sold, and our denominator is average inventory. You might be wondering why this numerator is not sales, and instead we use cost of goods sold. Well, sales includes a markup. Cost of goods sold is not just the cost of the company of making or buying the merchandise. So how does the cost of what we sold over the period compare to what we are holding in stock? This is an indicator of how quickly inventory is sold. The higher the turnover, the better the performance of the company, the more efficient. Why is that? Because each time a sale is made, the gross profit is earned. It is now we want higher measures clearly, but it is possible that inventory turnover could be considered too high if it means that not enough inventory is on hand for the company and the company loses sales to competitors because customers aren't finding their merchandise and are going elsewhere for it. Low inventory turnover is always a sign of a problem. Companies want to limit the amount of cash that's tied up in inventory due to the opportunity cost of a better investment for that cash, the storage cost of maintaining the inventory, and of course the risk of obsolescence, or the inventory becoming out of date and never being sold. Similar to how we looked at accounts receivable, our second measure of inventory, the activity or efficiency of inventory, is days in inventory. This is another way of saying this is days sales in inventory. And this is equal to 365 divided by the inventory turnover that we calculated up above. An estimate of how long it takes a company to sell its inventory, and of course the lower the number of days in inventory, the better. Picture your grocery store. Clearly you don't want to have inventory sitting around for too long. Alright, so let's look at these calculations for our three companies. GAAP does give us the amount of inventory. So I've calculated here, take their cost of goods sold from the income statement and divide it by average inventory. Of course, I had to add in a line to calculate that average inventory. And I get 5.12. This number can be interpreted a little bit more easily if we take 365 and divide it by the inventory turnover, and we see that GAP's inventory is on hand for about 71 days. That seems like kind of a lot to me without knowing and just thinking about going into a store and seeing the same merchandise there for 2.5 months. But let's compare it to its competitors. Urban Outfitters has inventory turnover of 7.07, and as we see here, quite a bit lower number of days in inventory. Let's look at that of American Eagle. 6.41 inventory turnover and about 57 days in inventory. So indeed we can see that Gap has their inventory is sitting in stores quite a bit longer. And here we can go to this ratio analysis of all three companies and compare the turnover. Remember we said higher turnover the better, and lower the days in inventory the better. So we can see that Urban Outfitters is the winner here. The next measure we're going to look at is the operating cycle. This is measured in number of days. Operating cycle equals days in receivables plus days in inventory. Remember what the operating cycle is. So when a firm starts out, it buys materials. It converts those into goods. It then sells those goods, most likely on credit. Then it collects the cash. And if that merchandise in the initial phase was purchased on credit, it's going to pay the supplier. and then repeat this cycle over and over again as often as it possibly can. Now you'll notice that the days in receivables is here, and the days in inventory is captured here. We don't see anything about days in, how many days that we have our balances outstanding in accounts payable. Some derivations, some estimates of the operating cycle will from this subtract out the days in that the balances are sitting in accounts payable, but I'm taking my ratio calculations directly from the CPA exam review material, so this is going to be the formula that you need to know. We're not going to worry about the days that the company has their amounts owed in payables. So operating cycle indicates the average number of days it takes to sell inventory and collect cash. The lower the operating cycle, the less time cash is tied up, and the lower the need for additional financing from creditors. So the lower the operating cycle, the better. Now these are easy calculations. Let's go to GAAP. All we have to do, since we have our information for days in receivables and days in inventory, clearly all we need to do is add them up. Do the same thing for Urban Outfitters and American Eagle, and let's take a look at what their results here. Operating cycle, now we can't do this for GAAP because we don't have the information for receivables, but we can see that Urban Outfitters has quite a bit lower operating cycle as compared to American Eagle. Our last measure of efficiency or activity is the asset turnover. I talked about this briefly in the profitability section 2 weeks ago, because we broke down return on assets into net profit margin and asset turnover. But it really, every time we're looking at a turnover, we're looking at efficiency or activity. So it's worth mentioning here. Asset turnover, it measures the ability of assets to generate sales. Sales are net sales divided by average total assets. Because why do we invest in assets? Simply so that we can earn revenue and eventually income. This goes back to my comic up here of the businessman telling the homeless man that it's easy to generate profits when you don't have a lot of overhead, you're not dealing with a lot of assets there. So the higher the asset turnover, the better, because it indicates an efficient use of assets. If asset turnover is decreasing, the company should start considering reducing its investments. Often we see this as companies such as Sears and JCPenney start to close stores and reduce this denominator here. So once again, we've already done the calculations for asset turnover, so let's just go back and compare the numbers for the three companies. Gap, we see, has the highest turnover. So although Gap's inventory is sitting out longer, we can probably say that it has less investment in plant, property, and equipment in order to earn the sales as compared to Urban Outfitters. Just noticing now, American Eagle actually has a slightly higher asset turnover than Gap does. So we would say that American Eagle looks the best in terms of asset turnover, then Gap, and then finally Urban Outfitters. That's it for our activity ratios. The next thing that you should be doing is working on the homework 3, our last homework of the semester, and then studying for that final exam. Of course, let me know if you have any questions.